This is going to be a little bit longer video than we know is probably smart to do, but with everything going on, we really wanted to hit some really critical points that we think are important. We're going to talk about the fact that we do and care and empathize with what people are going through. 2, that the proper action is preparation, not reaction. 3, how have we spent our week during this turbulent time? And number 4, what are the critical questions that you should be asking yourself? We've got them all timed out below the video so you can jump to them if it's not all of interest, but we hope this can bring some calm and comfort heading into what hopefully is a wonderful week for everyone. So if you're watching this video, I probably don't have to tell you, it's been a difficult week in the markets, arguably a difficult couple weeks. Last week's video, we talked about how headlines and events really don't have any predictive value on a move forward basis for markets. And even historically, statisticians, market analysts who have done look backs, even in hindsight, can barely explain 20% of market behavior based on events. I think when you wake up to a Monday like we had this week with more trade angst and market turbulence, it's just important to own the reality. Days like that aren't fun for anyone. As we've talked about again numerous times, they hit all of us on a gut level and create some emotional responses. The issue, though, just in terms of mindsets and disciplines as investors, is to look at this as just a season that'll pass. Just as winter comes every year, and it just means you need to make sure you're prepared and have a coat in the closet to be able to put on. There's a big difference between that type of winter and the winter they talk about in the Game of Thrones when they say winter is coming, where they're White Walkers and it is the apocalypse and the end of the world, for those of you who are familiar with the Game of Thrones. Those are two very different types of winters. One just happens every year around the calendar, and while many of us don't like it, particularly up here in this neck of the woods, it's something that we can't get emotionally invested in every year. It would just be tiring. So too markets, right? So important to know, when is this something that could be fatal to your strategy? When is this something like the flipping of a calendar that's just part of the reality? In talking through clients, I think another thing to be important about is really to step back again, not just think of that quick brain reactional level, but as Daniel Kahneman talks about, engage that slow brain and really ask ourselves some hard questions. Do we believe we can time markets? Do we think that there's a way to predict what might come down the path? I think most people will say, no, I know that that's not true. There's been lots of studies and statistics about that. Again, really in any respect, but certainly around events and headlines. And yet we all find ourselves at times maybe asking the question, what's next? Is there something we should do? Is there something that needs to happen within the portfolio or the plan? And at times it's just prudent questioning, and we'll get to some great ones to ask here at the end of this video. At other times it really belies that maybe deep down we think that you can time markets, which of course again, not really true, certainly not a sustainable strategy. So what can be done, and really what are some of the facts? Well, we've shared slides before where we show all the different headlines and how the market moves forward. I think one of the big things to understand is what isn't as important necessarily for a lot of particularly people with some time with their investments, of what you're in, assuming it's a well-built strategy, whether it's more growth-oriented is what I'm talking about versus more diversified, it's sticking to whatever you've designed, assuming soundness. So if you look at, and again, can get this type of material to anyone anytime, studies where they've looked at the long-term performance of an equity type strategy that's around 9-ish%, give or take, or you look at a more diversified strategy with some global stocks, some bonds, they all come around in that 8 to 9% realm. Now, the randomness of those returns is something we talk about for those people entering into retirement that needs to be taken into account. But it's sticking to that plan once it's built that's the critical piece. And that helps weeks like this, while they're certainly never fun, go from something that isn't just fun to something that isn't fatal. And that, again, is an important thing to keep in mind. So what is our action? Well, our action isn't to be reactive, it's to be proactive. And what I mean by that is really walking through clients, which we, broadly speaking, would put into two big buckets. income-oriented investors and then more growth-oriented investors. What do you need and what is that plan? And through good markets and bad, what would that strategy look like? For income producers, that's the ability to obviously rely on that income through good markets and bad and not be captive to needing a certain return to fund your retirement that can relieve hopefully some of that anxiety. For the growth investors, it's about looking at these sell-offs, these market weaknesses as opportunity. If that's your objective, you really should fall into one of two, maybe both camps. A, you've got time with that money to be able to let it ride through difficult markets. Two, you're able to add to it, your dollar cost averaging into those weaknesses. And I think that's critical. If you look back to the second most heinous market of all time in 2008, with a good income stream, you could have gotten through that and made it through just fine. And for growth investors, people who were able to continue to dollar cost average, an amazing opportunity to pick up deals. Where we react, and we'll use '08 as another example, it's actually counterintuitive to, I think, how most people think we would act, where most people would expect to perhaps call us and say, hey, what do you think we should do about this Trump trade news? And be like, run for the hills, we're gonna put 20% of your account in cash. Our reaction, again, not getting swept up in the up or down as we are about 1% this week type movements, but something more profound, 15, 20% type drawdowns, is probably counterintuitive to what most people would expect. It would be to go to look and find those most beaten up of asset classes and tacked into the wind. I don't know a whole lot about sailing, but I know turning your back and the boat's back to waves is not the right way to approach a storm, but rather to take it head on and to tack into it. So too with portfolio management. So be ready. And then when you are going to react, usually react in a way or act in a way that is counterintuitive to your gut. So again, to recap the points, number one, we care and empathize. We feel the same way that you feel in those weeks. Number two, the action that you want to take to markets is to be prepared and or go against your gut instincts, which would, of course, during difficult times, be telling you to run. So what do we focus on? How have we been spending this week? I wanted to take this opportunity to really talk about that. I've spent the most of my week talking with managers, so I want to know what they're doing. Certainly, we talk about geopolitical events and how they may be impacting markets and the decision-making of companies. But what I really want to know about is the same types of things, obviously, we hope our investors focus on, which is what, if any, of this is going to impact our long-term objective for these portfolios. So when we're talking to, for example, the Global Equity Fund that we do a lot of work with, I want to know, hey, dividends still look sound. Are we still going to be able to get that income stream? What are you hearing from the managers on the ground? What asset classes might you move into? And really focusing again on a positive, proactive type of response as opposed to one out of fear. Spending a lot of time, these moments create opportunities, and within the fixed income realm with rate fears and inflation fears, there's some new opportunities we're really excited to begin to implement here in the next few weeks for our clients that are positive things to focus on. We've been spending a lot of time with those managers. So again, it's a what can we take on, process oriented, really business as usual type approach. My portfolios, won't get into nitty gritty specifics, but I eat what I cook here, so own the things that we put our clients into, and to that end, because we do have more growth oriented investors, more income, this is my take on it. For my 401k, which tends to be more income producing type strategies, it might be a little bit less tax efficient. I'm obviously not doing it for a pending retirement, which is many years away. I look at, hey, this weakness coming into a quarter end is a heck of an opportunity. Huge dividend payments literally go out this Friday for a lot of our strategies, and I'm going to get to reinvest those dividends and that income at an opportune time where the market's sold off a little bit. So again, don't like to wake up to that red on the screen on Monday or a few other days this week. but really know that this is a long-term game and that I'm going to get to reinvest that. For people who are in the distribution phase, trust, know that income would be the critical consideration. For my growth stuff that I need to be more tax efficient, I never planned on using that money for many, many years. And again, it's a chance to dollar cost average with the next monthly paycheck to buy up some things that might be on sale. So focusing again on the positives, the control that this is the, saying goes, a marathon, not a sprint. So what questions should people ask? We'll wrap up with this. Number one, do you actually have a strategy, and is it sound? Is it whipped around by the feelings that you have? Is it based off the conflicts of interest that an advisor or a broker may have for you? Or is it really premised on a sound philosophy? Again, we've touched broadly speaking. If you're a more growth-oriented, tax-efficient type investor, do you have that dollar cost averaging plan? Are you working with things that, again, are well diversified in their own right, even if they have a growth objective? Most of them critically, for those people who are in that distribution phase, is your income sound? Are you able to generate enough income to make it through market cycles? The last thing you want to do is be relying on total return to supplement a large part of your lifestyle, only to have return disappear and have nothing to draw on and actually have to sell more off at a bottom than you would even want to. Number two, it isn't about, and this may be the most important point of the whole video, it isn't about really market changes. Has a circumstance in your life changed? Have you moved from someone that had a more growth objective to someone who needs to be more defensive? Have you had a change in the income needs you have, whether it's more or less, and can your portfolio reflect that? Maybe you don't need as much income as you thought you would, and you can be a bit more defensive with part of your portfolio. Maybe you need a little bit more income and you need to pivot from a growth orientation. But the changes that really should lead to reactions would be those in your circumstances, unfortunately layoffs, things like that, that you would want to make sure to talk with your advisor about. Finally, reassessing your risk tolerance. Everybody's pretty bullish. Everybody's pretty excited to be equity oriented during really great markets. Weeks like this are a great opportunity to ask yourself, are you really as aggressive of an investor as you think you are? Whether that's really aggressive and it's a little less, or moderate and no, I need to be even more conservative. Really, what is that? Can it still map to your plan? This is something we certainly can help with, number one. And number two, if that's the case, it again needs to be something you stick to. As I alluded to earlier, more diversified portfolios, more growth-oriented portfolios. The critical thing is sticking to the plan. What gets people in trouble is pivoting back and forth, back and forth. So with that, we'll wrap it up. Hang in there. We'll get through this together. For those of you, obviously, who may not be clients, we're happy to be a resource anytime. Thanks so much.